But what I tell everybody is there's nothing the matter with starting small and getting yourself in a habit of setting money aside. Because here's the thing. Let's say you set $100 a month aside. Okay. That's $100 focus, like you mentioned earlier, focused on the return, right? Technically, that is a 100% return on your money. Why do I say that? This is an interesting distinction because when you set that money aside, it's now money that is part of your investment portfolio. So that $100 that you put aside, you could say that I just made $100 return, okay? Because you're setting it aside. And that is in and itself the most important thing. And to do that religiously over and over again.
All right, guys, welcome to the Winner Circle podcast. I'm your host, Jay, and I'm thrilled to have you join us today for an episode titled The Secret of the Super Rich, How the Wealthy Stay Wealthy. And you already know, today we have an incredible person here. You can see him right there. You can see the Hilton brand. You know what that means. We talk about wealth. We talk about wealth preservation. We have a financial powerhouse, Mark Miller, with nearly 40 years of experience helping business owner, executives, and high net worth individual legally / taxes, grow wealth, and build a lasting legacy. And as you already know, or you don't know, Max is the co-founder of Hilton Tax and Wealth Advisors, alongside with Bradley J. Hilton, the grandson of the legendary hotelier Conrad Hilton. He's also the best-selling author of Hilton Wealth, How to Invest Like an American Dynasty, where he reveals the exact wealth building strategies used by the Hilton family and Fortune 500 firms. So he has been featured in the New York Times, Fox News, and many other platforms. He brings a rare insider's perspective on how the ultra wealthy preserve and multiply their wealth across generations, just like I said earlier. So in our conversation, Mark will share powerful insight into how strategic tax planning, disciplined investment, and generational wealth building can redefine your financial future. So we'll explore how the rich think differently about money and uncover the timeless principles that keep them ahead in uncertain times. So I want you to join us for an eye-opening discussion that will challenge you how you see wealth. And not just only wealth, success and legacy follows. Good to have you on here, Mark Miller.
Well, nice to be with you, Jay.
All right. Thank you so much. Looking at your profile, you've worked with some of the wealthiest families and executives for nearly 4 decades. How has it been like?
Well, it's been phenomenal. I mean, I came out of college. I actually worked for that small little company called American Express to start my career and got my feet wet kind of on what we call the retail side of the business, working for American Express and then some brokerage firms. And I was what you'd call a stock hawk, that I was just loved stocks and commodities and all of that kind of stuff. And I did a lot of options trading myself and everything and did really well when I was young. But as I matured in the business, I started to meet a lot more wealthy, super wealthy people, and was wondering, why are all these people investing in bonds and all of this kind of, safe stuff? I mean, I want to show them, how they can invest in stocks and equities and things like that. But the more I learned, and the more I met and got relationships, I learned that the wealthy are not just about taking a whole bunch of risk. Actually, the wealthy take probably the least amount of risk of any investors. And I was fortunate to start meeting a lot of ultra high net worth individuals, and met the Hiltons a number of years ago and started to do a lot of different companies with them. They've made me money. I've made them money. And then several years ago, they asked me to be the manager of the Hilton family office. And I do that, as well as a spinoff company that I'm kind of here talking about, is Hilton Tax and Wealth Advisors, which is basically a Brad Hilton, who is you mentioned the grandson of Conrad Hilton, is my main partner. And we had a passion for bringing these kind of advanced family office, high net worth strategies a little more down to Main Street, more average investors. So instead of having to have $10 million or $20 million to invest and do the things they do, maybe you only have to have two for 500 or 500,000 or millions. So it can be, those type of things could be more accessible to investors that normally would not have access to them. So that's, and part of it is us teaching people about how the wealthy, what we call the smart money folks, truly invest their monies. That's been my journey, and we just, are excited to teach people more and more how you do this, how you plug into these strategies when you don't have 10 million or 20 or $30 million or more.
We've seen, the introduction of how you got started, and which is a great, you know, path, pathway. So now let's quickly go to the mindset of the wealthy. You said that the wealthy think differently about money. What does that really mean? I've seen some of your words when you say the wealthy think differently about money. So what does that mean? I would also want you to share one specific mindset that separates the rich
Sure.
from the average earner.
Yeah, yeah. Well, the thing is, so anyway, again, we see all the ultra wealthy, and I always pick on Warren Buffett. Although I love Warren Buffett, I mean, he's got incredible ideas. But a lot of people think that he just invests in, like with Berkshire Hathaway, which is a company that invests in companies. So there's a lot of risk they're taking, all of that. They think, well, he's just amassed all his wealth there, so he's taking all these risks. And the reality is 60-70% of his portfolio is very, very safe, secure in different types of investments. So the wealthiest of the wealthy tend to protect their money because they have a lot to lose. So they have their legacy to lose. So they tend to protect most of it, but they're still getting plenty of upside potential in their portfolio. It's just that they're not doing that with the vast majority of their portfolio, like a lot of retail investors are. When I see people that come to me and maybe they have a quarter million, a million, 2 million, whatever. And 80% of it is sitting in the stock market because ironically, the stock market has really pumped lately. So they think that's the thing to do, or their brokers told them that's the thing to do. And they're taking a massive amount of risk where they have the potential to have a 40 or 50% drawdown. The wealthy do not do that. The wealthy, first and foremost, kind of put their investments in very kind of ironclad type of investments first, the majority of their portfolio, and then they go out and look for those select opportunities to grow their portfolio from there. So they're still making great returns. They're still doing, 8, 9, 10, 12, 14% per year, sometimes more, but most of their money is very safe and secure. So they're, again, because they have a lot to protect.
They have a lot to protect. From my own perspective, and from what people around always have that mindset, there are many people that we already know believe that getting rich is about earning more. And that's what we believe in, the capitalist America. We just want to earn more. But staying rich is another story. And that's what people can tell you because the bills are coming as the money is coming in. So from your experience, what habits or principle help the wealthy stay wealthy through generations? Because as you're getting it, you're spending it.
Yeah. Well, I talked about focusing on safety and security so they can keep that core portfolio in place for a legacy for the long term. But then also then another big way that they do this is through advanced tax planning. So the majority of the super wealthy do not pay any tax. And again, those are strategies we bring a little bit more down the main street. Most of all our clients are in the zero tax bracket too. But that is going to be your biggest expense. And that is ultimately the richest of the richest. That's their largest expense is taxes. So they're going to do different strategies, all legal, moral, ethical. It's not that, you hear out there that the legal or rich people are evading taxes, so they need to pay more taxes. That's not the case. And I'll dispel that myth. If there's people in your audience that are believing that the wealthy aren't paying their the people that have 100 million, 500 million, billion plus, they're driving our economy and they make it work for the rest of us. And they're employing tons of people that are paying tons of taxes and all of that. So plus generally the things that they're doing to get to the zero tax bracket are also generating more economic benefit and more taxes. Okay. So that's really a big myth, and I'm just going to dispel that, you hear it all the time that, oh, the wealthy aren't paying enough, all of that type of thing. They're generally paying more taxes than you are in a roundabout way, to the magnitude of 10 times or more. So, but if they can then mitigate that tax burden, then that allows them to put more money to work in their businesses, in the economy, all of that type of thing, and helps them grow their portfolio and helps them grow their legacy. So that's a big aspect of it too, and how the wealthiest truly get wealthier and maintain their legacy status over time.
Thank you so much. Yeah,
Mhm.
because that word taxes, it's very, very important. All right. Because a lot of people underestimate the power of tax planning. And that's how the ultra wealthy legally reduce their tax burdens, which is true. So, but if I'm going to ask also, we looking at an example from the ultra wealthy, what simple tax saving strategies can even small business owners or even high income earners start
Sure.
applying today if you're going to give an advice?
Yeah, well, what we generally do with our clients is we build, first of all, it's important to have a formalized tax plan. So, hey, I have a tax plan in place. Here's what I'm doing. I've got a business plan, I got a tax plan, I got a marketing plan, I have a plan for my family's budget, all of that. It's all about planning, but nobody has a tax plan. Their only tax plan is to get their taxes done at the end of the year. And that's not a plan. Okay. That's not a plan at all. So what we do is there's a lot of, first of all, the IRS codes are technically about 160,000 thousand pages long at this point. So you're thinking that if you're just doing the basic stuff like getting your interest deduction, home office deduction, things like that, that's just the tip of the iceberg. So what we do, and the Hiltons are kind of known for this. They're some of the best tax mitigators really in the world. Very, very good at it, and they're known for it in the space. So what you'll do is have some core basic strategies that are more deep dive type of code strategies that, again, all moral, legal, ethical, and everything, but they're what your normal CPA is not even going to deal with, and they're not even going to talk about. And then you have another level, which is a more advanced tax planning, which are deeper dive strategies that are taking advantage of things that the IRS is maybe that's helped driving the economy, whether it's energy related or whether it's in mining or whether it's in oil and gas or things like that you can then take, or debt structuring, things like that the government is saying, hey, this group gets special status and they get tax benefits. So you want to get plugged into the wealthy, get plugged into those type of strategies that reduce, again, they help expand the economy because that's why the federal government is giving benefits there, but they also give you as an individual great tax benefits and can help increase your deductions to the maximum.
Thank you for that clarification. And if you look at your profile, you've worked with Fortune 500 firms,
Mhm.
even family offices, Hilton's, and what do they do differently when it comes to protecting their assets? Because a lot of people make so much wealth
Mhm.
and just one mistake mess everything up. I can
Yeah.
count how many people I know that just one lawsuit from someone and everything is gone.
Yes.
So how can they protect their asset?
Yeah. So generally, we're going to do more advanced tax structuring for folks that have a lot of wealth. And what that does is it gives layers of liability protection for them also. And I'm talking beyond what you know about a living trust or just, regular estate planning, maybe irrevocable trust structures, charitables, I'm trying to say, trust structures to then also give them tax benefits in the process. So that's what they're going to do long term to protect. So to protect their assets, though, like in me and Brad Hilton's book, Hilton Wealth, we talk about kind of a bucket concept to where there's four buckets. Two of the buckets are, the first is a 100% guaranteed bucket where they're protecting their assets. The second bucket is like a guaranteed income bucket, which those are where the majority of the money is. And then we've got a couple buckets. One bucket's more of a managed money at risk bucket, and then also an alternative and private equity bucket too. Okay. So they're protecting their assets throughout that legacy. And generally those assets and those portfolios are going to be structured into their trusts.
Thank you for. So let's quickly talk about that book. You talk about, the Hilton Wealth.
Mhm.
In the book, you talked about how dynasties invest. So I want you to break down one or two core investment principle.
Yes, absolutely. And we've talked a little bit about that in that structure. That's our way. Now let me clarify something. The wealthy are not technically doing, and I talk about this in what we talk about in the book, the bucket concept. Okay. That's more of a retail concept. But what we were trying to do was say, how do the wealthy invest, and how can we make it simpler and easier and very understandable for, again, more of an average investor. So, and that is what I was just discussing, is they're going to have a well-allocated portfolio, but that's leaning heavily towards safety and security. And what a portfolio like that is going to do for the wealthy and for the investors we're working with in Hilton Tax and Wealth Advisors is allow for less expenses, which is a huge thing. That's one of the things that the wealthy, they don't pay a lot of fees like a retail investor would pay. Get a lot more safety and security, which gives you less volatility in the portfolio so you can sleep at night better. And ultimately that also equates into better returns. So let's say a retail portfolio might make 6 or 7% per year. By the way, the average retail investor doesn't make that. It's easy to say that, but when they're going in and out of the markets and they're having big losses, which I believe we're probably around the corner from another big drawdown. I mean, it's kind of common sense. We will be soon. And instead of participating, in that complete drawdown, you have a well allocated portfolio that maybe instead of being down, let's say 40 or 50% in a given year, you might only be down 7 or 8%. Okay. So when we have that less volatility, it allows us to get back to positive returns faster, and then ultimately gives.
Hey, winners, as we continue our journey together today, I want to share something truly special with you. Over the years, I've had the privilege of coaching countless business owners, entrepreneurs, leaders, guiding them to achieve breakthrough results and unlocking their full potential. So I'm opening up just 4 slots for my monthly business coaching program. That's right, 4 slots. After being fully booked for the past 3 years, if you're ready to elevate your business with personalized guidance, proven strategy, and a supportive community, I'm here to help you navigate challenges, refine your vision, and achieve your goals. So if you're committed to taking your business to the next level, I want to hear from you. Reach out to me directly at Jay at winnercirclewithj.com and discuss how we can work together to build the future your business deserves. So don't wait. This is your moment. Join Winner Circle and let's embark on this transformative journey towards success together. And now let's dive back into today's episode.
Us better returns. So the retail investor might make 7% or 8%, whereas a smart money investor might make 10% or 11%.
So let's look at an everyday investor right now. How can they approach that same tactics, even on a smaller scale?
Yeah. So I'll give you just some general advice. Again, back to safety and security. Look for things that are going to provide more safety and security and get 50 or 60% of your money very safe and secure. And no matter what happens in the economy, no matter what happens in your portfolio, that chunk is going to stay intact. And then 40% of it, go look for those things that are at risk that can grow your portfolio to a greater extent. Again, I'm not saying people can talk to us and come and talk to us and we can show them how to do this properly and right. But if they're doing this themselves, they need to make sure that they're finding the best investments in those safe buckets that can get good returns. For instance, like we have at our disposal, we can be in a guaranteed bucket, but still make 5 or 6% per year. Okay. You can't do that with government bonds or municipal bonds or anything like that. But kind of in that smart money world that we work in, we can find those things that are still going to make a good return. So we're not talking about taking your money and sticking it under a mattress. And then when we talk about it, if they're going out and they're looking for at-risk investments, look for good managed money portfolios. Look for maybe opportunities, say on the alternative side, if that they tend to be more available now than they were. But like what we have available is in those two last buckets, then our managed money bucket, which is some of the best money managers in the world. And then the alternative private equity bucket, we've got 7 or 8 different offerings from different private equity firms, issuers that can make, mid-teens and higher. And in that managed money portfolio, we can do 8 to 12, depending on what their risk profile is. Okay. So what I'm saying is, and I'm not, I'm here talking about our book, obviously promoting our company, but at the same time, if you do enough research, you can go out. Generally, what you want to do is find for the core of your portfolio is good quality, low risk or guaranteed assets that have the best yields possible. And then going out and searching out on the at-risk side of your portfolio, the best quality type of investments that you can find that have higher yields, but also understanding and realizing that there's risk involved there too.
Is there a balance between playing safe and taking calculated risk when it comes to investment?
Absolutely. Yes, there has to be. And, in our true wealth portfolios, we usually do an analysis, kind of a deep dive into a person's situation, and then figure out that exact mix in those 4 buckets I talked about with the true wealth portfolios. So everybody needs to take a look at that, and you need to be properly balanced because, I always use the word synergy, and I've got some of the people in my office are like, that's too big a word. Well, not really. It's not, because synergy means basically that everything is working together and the components are all working together to make the whole system run properly. So in a good portfolio, every different, like the buckets I talked about, every one of those buckets have to be perfectly aligned with the other bucket. And that way, all of them work together for the best returns, the lowest fees, the least volatility, the best returns long term. So synergy is a big thing. That's a word that we use in the Hilton family office with our very, very ultra wealthy clients, is that synergy is not just about the portfolio synergy, but it's also about all the advisors working together synergistically.
Hmm.
What your financial advisor, your insurance person, your tax person, your trust person, everybody's working together and putting all the pieces together, because all of it, one piece of that can go wrong can bring all of it down. So all of it has to work together, and all those different areas help the other areas to make somebody wealthier faster.
Great. So now looking at, we've talked about building wealth and, having all the necessary wealth needed. But let's talk about, as we begin to round off, let's talk about some families, they lose their wealth within generations. What do you think happens? And how can people avoid that trap?
Yeah, that's a great question. And I was just on another podcast and we were really diving deep into that. Here's what happens, and you've probably heard this. Usually very, very wealthy families, all the money is lost by the third generation. Why is that? Well, first of all, the first generations that's building the wealth, the first and the second is generally building the wealth, because the first generation generally gets family members involved. Okay. Younger family members involved, and they're learning from that first generation. That first generation, and to some extent the second generation, are the strivers, are the ones that are building and the ones that are putting massive sweat equity into it, and they understand the business and they know how to build the wealth. But by the third generation, that's starting to get lost. And the mistake that a lot of, and what we do with our families, is we make sure we have really good ironclad legacy plans that involve kind of trust structuring and layering, to where that, especially that third generation, is going to get the money in increments. It's not all just going to fall into their laps and then putting things in structure where or in place in the structure where the second generation can have that time to spend more time with the third to get them involved in the various businesses or whatever they're invested in to teach them how to take care of the money. So they're getting the money incrementally. They're not getting $1 billion dropped in their lap. They're getting the money incrementally, and they're also learning how to handle the money over a decade's amount of time. So that way, hopefully by the third and even the fourth and fifth, if we've structured that possibly or possibly the best we can, then by that fourth and fifth generation, the money is still going to be there, still intact, and it's going to be taken well care of.
The ones who are going to listen to this conversation after this live version, I'm sure they're going to stick to it and want to listen to it over and over again. Also, if you're listening to this, try to share to your friends, share to people who need knowledge, and also people who also need to build their portfolio. All right. Apart from that, as we begin to go to the closing of this conversation, I wish we had more time, but we have constrained with time. I know you've had a remarkable career helping others grow wealth. What's one lesson you wish everybody understood about money?
But this is interesting. It just popped into my head is that, we're talking about, if there's people listening that are just now starting on the path or whatever, setting money aside and saving money. If you look at the ultra wealthy, generally, most of the ultra wealthy have gotten really wealthy from building big businesses. Some of them gotten wealthy from investing, but primarily businesses and all of that. But what I tell everybody is, there's nothing the matter with starting small and getting yourself in a habit of setting money aside. Because here's the thing. Let's say you set $100 a month aside. Okay. That's $100 focus, like you mentioned earlier, focused on the return, right? Technically, that is a 100% return on your money. Why do I say that? This is an interesting distinction. Because when you set that money aside, it's now money that is part of your investment portfolio. So that $100 that you put aside, you could say that I just made $100 return, okay? Because you're setting it aside. And that is in itself the most important thing, and to do that religiously over and over again. We talk a little bit about this in the book, Hilton Wealth. By the way, everyone can get a free copy of that, a complimentary copy, if they go to hiltonwealth.com, which is our website, hiltonwealth.com, our company's website. Just go on there, order the book, and we'll send a complimentary copy to you. But we talk about the concept of, investing over a long-term period of time, and don't be discouraged by, I don't have a whole lot to invest. Well, it's time, it's patience. By the way, the wealthy have a lot of patience. Okay. And that's what you need to have. You need to obviously fund into your dream, so to speak, and then just be patient and let time do its thing by gradually putting money in. It'll build over time. You'll make returns. And then if you do it long enough, you'll be surprised at really the results that will yield for you.
So much for that powerful word. And the word patience. Patience is very important. Patience is key.
Yes.
Ability to stand in time and wealth to rebuild. So if you could summarize how the wealthy stay wealthy in one sentence, what could it be?
I would just say, patience, time, being safe, being secure. Those are the keys.
Those are the keys. Those are the keys. Thank you for your time. And that brings us to the end of another powerful episode of the Winner Circle podcast. And I want to say a huge thank you to Mark Miller for joining us and sharing his incredible insight into the mindset, the discipline, and strategies of the super rich. And from exploring how the wealthy think differently about money to uncovering timeless principles of wealth preservation, Mark has shown us that financial success isn't about luck. It's about strategy, mindset, and intentional planning. All right. So if you can also reach out to him directly if you have any question about this conversation today. And also, if you found this conversation valuable, be sure to subscribe, rate, and review the podcast on your favorite platform. And because your support itself helps us continue to bring in inspiring dialogue with thought leaders and innovators from around the world. And also connect with us on social media to stay updated and join the conversation. We'd love to hear your biggest takeaways from today's episode. So thank you for being part of the Winner Circle today. Remember, wealth isn't just about accumulation. It's about intention, impact, legacy, and patience also. All right. So it's very, very, very important. So until next time, I'm Jay Adewole, and reminding you to think big, act wisely, and build your dynasty.